All right, let's jump right in. There is a huge, a massive opportunity in the world of finance right now that a lot of investors are just completely overlooking. It's kind of hiding in plain sight, and today we're going to break down exactly what it is and, more importantly, why you should care.
So check this out. This is really the heart of the whole story. You've got developed markets, right? Investors are paying a massive premium. We're talking $3.20 for every $1 of a company's actual worth. And what are they getting for that price? Kind of sluggish growth, around 1.7%. But then you look over at emerging markets. They're growing more than twice as fast, but they're trading at this huge discount.
So you have to ask, right? Why? Why does this giant gap even exist? Why are people paying so much more for so much less growth? Honestly, it's a puzzle. And the answer to that puzzle? Well, that's where one of the most interesting investment stories in years really begins.
First things first, let's really get into the weeds on the numbers behind this whole disconnect. Because this isn't about gut feelings or speculation. This is about cold, hard data that tells a pretty unbelievable story. The big headline number is this: 40%. Right now, emerging markets are trading at a 40% discount to developed markets. To put that in perspective, the average discount over the last 20 years has been about 17%. So we are way, way off the historical norm here. It's a massive gap.
And here's the kicker. The very same assets that are 40% cheaper, they're the ones that are projected to grow at 4.2% next year. Meanwhile, the expensive stuff is only forecast to grow at a measly 1.8%. Just think about that for a second. You're literally paying less to get more growth. It just doesn't make sense.
Let's break it down to what it means for your wallet. When you invest in a developed market stock today, you are paying $3.20 for every single dollar of that company's assets on the books. In an emerging market, you're paying just $1.80. It's an absolutely stark difference in what your money is actually buying.
And I think this quote from the source material just hits the nail on the head. This isn't some crazy, complex Wall Street formula that you need a PhD to understand. It's basic arithmetic. It's telling us that one of these prices has to be wrong, and all the evidence is pointing to the expensive, slow-growth one.
Okay, so we've nailed down the what, this massive valuation gap. Now let's get to the fun part, the where. Let's put a face to these numbers and look at the actual countries that are powering this incredible growth story.
First up, India. The story here is just phenomenal. You've got a country with a median age is only 28. That's a demographic wave that can fuel growth for decades. Their GDP is set to grow at 6.6%. They built this incredible digital infrastructure that's ahead of the West in many ways, and they're benefiting hugely from manufacturing moving out of China. It's a total powerhouse.
Then you've got Vietnam, a country that's just on an absolute tear. We're talking 6 to 7% growth every year. And as you can see here, it's about to get a major upgrade to emerging market status. This means it's not some speculative frontier place anymore. It's becoming a key player in the global economy, a manufacturing hub for giants like Apple and Samsung. It's a graduation.
And this story is way bigger than just one or two countries. The whole Southeast Asian region is just exploding. Their digital economy is on track to hit $600 billion by 2030. And that's not just people buying stuff online, it's digital payments, fintech, streaming, a whole new economic layer being built from the ground up, mostly on smartphones. And it's not just an Asia story either. Let's look at Latin America. You have countries like Mexico and Brazil that are seeing a huge benefit from nearshoring. That's just the fancy word for companies moving their supply chains out of Asia and closer to the US to make them more secure. This is a real global shift in how the world does business.
Okay, so the opportunity seems pretty clear, pretty compelling. But how do you actually invest in it? Let's talk about the practical side of this, because it's definitely not without its own set of risks and challenges.
And I know what you're thinking because it's the obvious question, right? If this is such a great deal, what's the catch? Why isn't every investor on the planet piling in? It's a totally fair question, and it's so important that we address the risks head on. Look, the risks are absolutely real. You've got currency swings that can wipe out your returns overnight. Political instability is just a fact of life in some of these places. Geopolitical tensions, especially around China, add a layer of uncertainty. And many of these economies still ride the roller coaster of commodity prices. You absolutely have to go into this with your eyes wide open.
So the key isn't to ignore the risk, it's to have a smart strategy to manage it. A good approach could look something like this. You can start with a broad, low-cost ETF just to get your feet wet. Maybe consider an active fund manager who really knows the landscape.
The most critical thing is to diversify. Don't put all your eggs in one country's basket. And a lot of people like a core satellite model. A big, stable index fund is your core, and then smaller, more targeted bets on the side.
So we've covered the what, the where, and the how. For this last part, let's talk about the why now. What is it about this particular moment that makes this opportunity so urgent?
Well, what you have is this powerful mix of factors all coming together at once. As we've seen, valuations are scraping the bottom of their historical range. The strong US dollar, which has been a major headwind for these markets, finally looks like it's peaking. The US Federal Reserve is signaling it's going to start making money cheaper, which is like a jet fuel for these economies. And that whole China plus one trend is a tectonic shift that's only just getting started.
And really, it all comes down to the psychology of the market. Right now, most people are pretty pessimistic about emerging markets. But, as this slide points out, that's often the best signal you can get. The greatest opportunities in investing are almost always born when the fundamentals are strong, but the feeling in the market is weak. That gap between perception and reality, that's where you find the value.
And I think this quote just perfectly sums up the challenge here. If you wait until everything is perfect, until all the risks are gone and the story is on the front page of every newspaper, well, by then the opportunity will be gone too. That 40% discount we see today is the price you're being paid to deal with a little bit of uncertainty.
So we'll leave you with this one question to think about. After a decade dominated by US tech stocks, will the next decade belong to the economies where the growth is actually happening, where the populations are young and dynamic, and where assets are still on sale? The data certainly makes a compelling case. The only real question left is whether investors will see it before it becomes obvious to everyone.